Joining us right now to talk more about the bond market and which areas might hold promise going forward is John Miller, portfolio manager at Nuveen Investments. He controls more than 1,200 muni bonds alone. John, great to have you back with us. Interesting here, and the connection is that obviously state and local governments have been able to make these investments with banks because of the giant muni bond market. What are we talking about as far as size of the muni bond market, and which direction are we going here, growing or shrinking?
Well, it's roughly a $2.8 trillion market overall. But over $300 billion worth of municipal bonds each year get called, redeemed, mature, and have sinking fund payments. And the new issue supply, while it is significant new issue supply, likely to be $400 billion or more in 2010, more and more of that supply is coming taxable. So the tax-free component of the municipal bond market is probably going to be shrinking marginally this year.
And this is part of the federal government's Build America bonds, their push to help these municipalities finance their growing deficit worries, really, more cheaply, right?
Well, it's primarily used to finance infrastructure and also to help take some of the burdens off of the municipalities so that they can work on deficit reduction, because the recession has produced some deficits. The way in which the federal government helps is really it's really twofold. And one is that if the municipality issues taxable bonds, they are issuing it into a larger, broader, deeper type of a marketplace, so that potentially more demand. And also, the net interest cost is subsidized by the federal treasury, where the municipality will receive, in this year at least, 35% of the total interest cost of the deal cut back to the municipality from the U.S. Treasury.
You know, John, there's a lot of talk lately about whether the U.S. states look better or worse than the European states that are currently having real sovereign debt problems. Where do you see the most attractive places to invest when you want to balance the most yield that you can get, but steer clear of any possible risk of default?
Sure, that is it's a very, very differentiated marketplace. And it's differentiated in credit, it's differentiated along the yield curve, and the pricing of municipal bonds can be vastly different. So the highest quality AA and AAA municipal bonds that are short in on the curve, on the yield curve in maturity, they have the least risk. Those are very, very strongly in demand right now, so their yields as a result are quite low. 0.5% up to perhaps 2% for short-term, very high-quality securities. And for more risk-tolerant investors, there are significantly higher yields further out in the maturity spectrum, so they will take on a little bit more interest rate risk. And also for middle-tier credits, BBB and single-A rated credits, there are some stable, essential service-type bonds that would yield north of a 5%, and also may be exempt from state taxes as well. And that's where we can find selected opportunities.
Are there certain states, John, that you would stay away from, states that have their finances in such disarray that you'd rather just not look there?
Well, I would not say that. I would not say that about an entire state. The more difficult areas from a liquidity perspective, there's lower demand for Michigan municipal bonds in the secondary market, just as an example. But that does not mean that we would not be potentially buyers of individual credits within that state, even though that is more challenging because of the economic overall economy and the recession hitting Michigan harder. Similar thing goes for the state of Nevada. Doesn't mean there aren't good opportunities in those states, though.
All right. Hey, John, thanks so much for joining us. John Miller there, portfolio manager at Nuveen Investments in Chicago.